Coming up on Market to Market, President Obama proposes a $4 trillion budget to the GOP-controlled Congress. And producers navigate a complex maze of new federal support programs. Those stories and market analysis with John Roach next.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it. This is the Friday, February 6th edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. 5.5 years after the Great Recession officially ended, the U.S. job market is finally exhibiting growth in hiring and wages. The Labor Department reported Friday that U.S. employers added 257,000 positions to their payrolls in January. The hiring spree included key sectors of the economy. Construction firms hired 39,000 workers, while manufacturers created 22,000 jobs. The key development, however, was that average hourly wages soared 12 cents last month to a 6-year high of $24.75. America's unemployment rate rose 0.1 of a point to 5.7%, but that was because more than 1 million Americans, the most in 15 years, began looking for work. President Obama, of course, hopes to put even more Americans back to work, and this week he unveiled his spending plans for 2016. The president rolled out a massive budget this week, proposing significant increases for the Departments of Labor, Interior, and the Environmental Protection Agency. The federal spending on health and human services and Social Security would both exceed $1 trillion in 2016, and along with defense, Treasury, Veterans Affairs, and agriculture account for more than 80% of the total spending. Tack on a litany of other federal programs, and the price tag amounts to more than $4 trillion. Obama proposed a 55% raise in spending for the EPA, the second highest rate this year of any agency. Most of that increase comes in the form of a $4 billion plan to slash pollution blamed for climate change. That provision requires Congress to find an offset to pay for the cuts deeper and faster than required in previous legislation. This and most of the president's ideas were given a cool reception by Republican leadership.
The president provided the American people a good laugh yesterday. He sent up his budget. More taxes, more spending, bigger government here in Washington, the same old policies that have failed for the last 6 years.
The Agriculture Department would lose one of its main functions under the budget, as the proposal would shift USDA's Food Safety and Inspection Service to the Food and Drug Administration. Overall, USDA's budget would increase 3% to $156 billion to include spending on nutrition programs already required by law and farm subsidies. Food assistance spending alone is expected to cost $84 billion as rising food costs offset a projected decline of recipients. Perhaps most important to farmers would be the demise of the trust fund loophole. This would change the step-up in basis on assets you leave to your heirs.
The budget I've sent to Congress today is fully paid for through a combination of smart spending cuts and tax reforms. Let me give you an example. Right now, our tax code is full of loopholes for special interests, like the trust fund loophole that allows the wealthiest Americans to avoid paying taxes on their unearned income. I think we should fix that and use the savings to cut taxes for middle-class families. That'd be good for our economy.
The president's budget would expand research and development of renewable fuel sources, including solar, wind, and geothermal energy. Energy Department spending would rise by nearly 14% to $29.2 billion, One other highlight changes the Energy Information Administration to increase the data it assembles, including monthly movements of crude oil transported by rail and electricity generated by small-scale renewable energy sources. America's aging infrastructure is likely going to get an overhaul. Transportation spending would increase by 31% to $94 billion. Most of the funds for a 6-year highway and transit plan would receive a one-time infusion of $238 billion. Those funds would come from new taxes on profits of U.S. companies currently avoiding paying Uncle Sam on profits made overseas. The president proposed increasing the Agriculture Department's portion of the budget by more than $4.5 billion. While the vast majority of the money will be spent on food and nutrition assistance programs, farmers also could benefit from government largesse. Gone are the days of direct payments, which compensated growers regardless of prices or yields. But producers now must decipher a dizzying array of new federal support programs. Paul Yeager explains.
Looming deadlines are putting pressure on farmers trying to weigh new commodity support programs included in the latest Farm Bill. And experts say the new guidelines, including significant departures from direct payments of recent years, can be challenging to understand.
We're hearing that some farmers are signing up, some are still confused about the process. There's a lot of meetings going on.
At one meeting in Eldora, Iowa last month, experts spent 2 hours outlining the best way to compare the various commodity programs. Despite praising presenters for walking them through the complex maze of information, some farmers were still less than confident with their decisions.
The bottom line is this Farm Bill has a lot of new acronyms, it's got a lot of new definitions, and so when we first started after the harvest season, guys just coming in off the combine, coming in out of the field, they hadn't any time to prep. So it was all new stuff, and basically they walked away stunned.
Crop producers, however, are learning new acronyms which, for them, represent the most important portions of the 950-page Farm Bill. PLC, ARC County, and ARC Individual.
I've got my own thoughts on what they may stand for, but I better not share them on TV.
Sure, agricultural risk coverage or something is the first one, and at the county level and individual level and PLC. Price loss coverage, is that pretty close?
When producers select price loss coverage, agricultural risk coverage county, or agricultural risk coverage individual, they are making a 5-year commitment. Between the reality that they are committed to their choice until 2018 and the fact that they are no longer guaranteed an automatic payment, the stakes are high.
That's what's scary about it, because it's so hard to predict where we're going to be 2, 3, or 4, 5, and especially 5 years from now. It almost seems algebraic in that we don't know what the price is going to be for the next 5 years. So we're going to almost have to kind of make our own predictions and let the chips fall where they may.
Some farmers wonder why the authors of the new commodity programs would make them so complex.
I'd like to know who they are. It'd be interesting to just see what their thoughts are as they set this up, to see if they know anything about agriculture or farming themselves, or if they're just know a lot about economics. It'd be hard to make it more complex.
At Market to Market's request, Leibold gave the non-simplified, acronym-filled explanation of all the factors a farmer should consider before locking in one of the programs.
If I was looking at ARC County, ARC CO, then I'd be taking a look at what's my adjusted gross revenue. So I have to take my Olympic yield times my Olympic price to come up with my gross revenue. Then I have to have my 14% deductible for my shallow loss. So I did multiply my my gross revenue by 86% to come down to my guaranteed revenue. And then I have to think of.
His typical spiel is a bit more user-friendly. Step 1, update historical yield figures. Step 2, consider changes to your base acreage. Step 3, research ARC and PLC options. And Step 4, sign on the dotted line.
So it's fairly simple.
February 27th is the deadline for making changes to a farm's historic yield numbers. The opportunity to adjust those figures typically arises only when a new farm bill is passed.
The last time we did it was 2002. So if I encourage anything, I encourage our producers to get that data from your insurance agent or pull up your own records, bring them in and try to increase your yields, because that's going to make a difference on what your payment is.
Those who fail to make adjustments by February 27th will see their historical yield averages remain at levels established in the past. The other important deadline is March 31st, when those with covered commodities should select one of the 3 programs. Otherwise, PLC is the automatic default. All the options require farmers to estimate future price trends.
Everything is so complicated and so complex, like he mentioned, the economy of China and the weather in Brazil and what's going on with Russia. All those things impact the markets, and you cannot predict that future. You just really, he said, who would ever predicted $2 gas? Are you going to predict $2 corn again?
Richard Dreifke, a producer from Hubbard, Iowa, and his nephew Clint Miller signed up at the Farm Service Agency office in Iowa Falls last month.
We've decided to go into the Ark County program. It's based off the average market prices for the year, and it goes back 5 years. And with prices a lot lower now, they have been higher. There's going to be a payment for sure for 2014 and probably 2015, maybe some in 2016. With PLC, the price has to be under $3.70 for corn and $8.40 for soybeans. So I guess we're banking on prices being higher than that.
Dreifke's nephew agrees.
There's more guaranteed money up front, and it's hard to pass that up. The PLC has a good floor for the future, but you never know if prices will get that low.
The whole idea behind this farm bill is to say, okay, we want to give the producers an opportunity to adjust to world markets and changing times. We want to protect them on the downside, but we're not going to bail them out completely.
Leibold suggests that producers, regardless of region or commodity, enter their own data into online calculators, such as those provided by Texas A&M or the University of Illinois, before selecting a program. Experts say farmers also should consider crop insurance carefully in light of the new programs.
With this farm program not having a guaranteed payment, I think it is shifting to promoting insurance and letting the producers know that there's no payment that's guaranteed. So you are going to want to insure your crop outside of FSA to make sure that you're covered in all areas.
Most producers acknowledge that, despite the headaches, tax-funded support during tough times is something they cannot afford to lose.
It provides a safety net no matter which you choose for the farmer, and it's a necessity, I think, in today's times with as many dollars as we've got invested in a year's crop.
Many producers also are sensitive to the public perception that farmers are over-subsidized, and they understand why a different approach to government support is being tested.
I'm a taxpayer too, so why did I get why do I get a farm bill subsidy or payment when we had $7 corn? That's ridiculous.
Officials are asking farmers to stop at their nearest FSA office soon. Lines may run long as the deadline's near. For Market to Market, I'm Paul Yeager.
Next, the Market to Market report.
Grain futures contracts finally had a winning week, thanks largely to a weaker dollar. For the week, March wheat gained 24 cents, while the nearby corn contract moved 16 cents higher. Soybeans also advanced as the March contract improved by 13 cents. Nearby meal prices, however, lost 50 cents per ton. In the softs, cotton rallied again this week as the May contract advanced by $1.61 per hundredweight. Over in the dairy parlor, both the nearby and deferred Class 3 milk contracts gained 40 cents. Hibernating bears returned to the livestock pits, where the April cattle contract lost $1.25. Nearby feeders declined by $5.75, and the April lean hog contract moved nearly $3 lower. In the currency market, the euro extended its upward move, gaining nearly 3 basis points against the dollar. Crude oil gained $3.45 per barrel. COMEX gold declined by nearly $50 per ounce, and the Goldman Sachs Commodity Index advanced by more than 20 points to settle at 409.05. Here now to lend us his insight on these and other trends is our senior market analyst, John Roach. John, welcome back.
Thanks, Mike. Nice to be here.
Well, we're glad to have you here. It's neat to have you here on a week we see the grains begin to rebound. And as we take a look at the wheat market this week, was it just the weaker dollar that drove us higher?
No, I don't think it was. I think it's also the concern about the Soviet or the Russian crop and really the whole former Soviet Union because they've had weather problems starting their season. They've had pretty good moisture after they got into the worst part of the winter, but they started with problems, and those problems are now expected to show up as the wheat comes out of dormancy.
All right. Now, we do have a question here from one of our followers on Twitter and Facebook. He found us at Market to Market, and his question is from Chris in Minnesota, and he's curious, do you see this week's rally in the wheat market to continue?
I think we should continue. This is a good month for wheat to rally. February is when we start to look at wheat breaking dormancy, and when we start to see whatever problems might be out there, or we worry about the problems that might be out there. And so wheat's been a very cheap commodity, and I expect it to stage a little further rally.
That being said, do you have any sell signals on in the wheat market currently?
We don't currently, but the market's moving in the right direction, and our indicator is moving up. We're probably a few days away from a sell signal, but we'll want to be able to take advantage of a sell signal when it comes on wheat.
All right. Well, now let's jump down and talk. The corn market also had an impressive rally beginning early in the week when we had those big moves upward, and it managed to hold on to most of it. Similar story in the corn market?
The corn market's a little bit different story in that we're reducing the ending stocks as we look out ahead for next year. We know that the plantings in South America were down. We know their production is going to be down from what it was last year. We expect that the U.S. plantings will be down. We think in the neighborhood of 1.5 million to 2 million acres. And we had extremely good yields last year. It'll take very beneficial weather in order to equal that this year. And so we think when we finally count all the numbers up in the fall of 2016, there will be fewer bushels out there than the fall of 2015. And meanwhile, in the fall of 2015, where we thought it was going to be something in excess of 2 billion bushels, people are now down in the neighborhood of 1.875. So we're actually shrinking the stocks a little bit and looking forward to a further shrinkage of stocks the following year.
So as we look at old crop corn today, there's still a tremendous amount of corn out there in the countryside, relatively unpriced. Should producers be looking to get some of that in, or do we wait a little while and let this run higher?
I wouldn't wait on any of the grains. I think what you have to do is you have to watch the market, and when you start to see the technical indicators getting up toward the top and we start generating sell signals, we think you should take advantage of all the sell signals from now through midsummer. We have the kind of markets that it's going to take something really unusual to get prices really performing. We don't see that. It may well happen if weather doesn't cooperate. We may well see the corn market move considerably higher, but that's still a couple months away. And at the moment, we think the market can rally up into where it runs into farmer selling. Now, it was in several meetings, 3 meetings this week with farmers, and I asked the questions, how many of you have corn to sell 10 cents higher? Almost nobody. 20 cents higher, a lot of people. 40 cents higher, everybody. So the market's going to run out of buying power, we think, if we move the market beyond maybe 30 cents. That would be kind of the outside of it.
All right. So keep an eye on that level when we get up into the mid-14s.
More importantly,
close to 420.
More importantly, rather than the price level, the more important thing is to pay attention to the technical indicators. And when you get sell signals, don't fail to be making sales.
All right. Well, now let's jump into the soybean market. We did see another move up there again this week, 12 cents higher in soybeans. Has export demand continued to be tremendous on the bean side?
Well, it slowed down finally this week, but prior to this week, it has been. We have sold, I think or shipped 180 some million bushels more than the government, than we did last year. And the government, I think, is forecasting 143. So we're about 40 million bushels bigger than what we need, than what the government has forecast. So exports have been good, but this is the first week they fell off. We also saw I think we're up to ship number 7 leaving the biggest port in Brazil, Santos. So their harvest has started in South America, and we're starting to see those supplies come on. However, South America has had some problems, Brazil particularly, Argentina not so much, but Brazil has had problems, and it's been drier than normal in various areas and warmer than normal. And so we think that the yields could be a little more variable than we've seen in past years, and we think that may pull the size of the Brazilian crop down a little further. We've already seen the numbers come down some. We think it can come down another 1 million or 2 million tons maybe. And so we think that there's a little bit of a reason for the market to stage a little further rally. But again, when we get sell signals, we're going to be very aggressive in selling beans.
And you're going to be aggressive selling old crop and new crop, do you think? That 2 million fewer corn acres could go right into soybeans?
Yes.
All right. Well, keep an eye on those markets. Now, John, let's talk cotton. That has been on an upward trajectory here the past few weeks. We've pushed through $60. Does that look like it's going to continue?
We triggered a sell signal there. So we have one market that we've triggered a sell signal in this week, and we think that if you're holding on to cotton inventories, you need to be selling into the marketplace. We should get a couple more yet before summertime, so we wouldn't maybe sell everything if you're optimistic, but we are in the sell period now.
Generally, an incremental sale is the way to approach one of these.
We think incremental sales make best sense because so much depends on the growing season, what's the weather like, and so forth. So we'll sell a piece now, we'll sell pieces on additional sell signals as they come along.
All right. Well, now let's jump down into the livestock market. It was a whipsaw effect in the cattle markets this week, and we saw them finish Friday limit up, I believe. Mm-hmm. What does that tell us for the strength of that market? Have we put a bottom in on the live cattle futures?
Perhaps the live cattle futures are well beneath the cash market. Huge discount. Now, we recovered quite a bit of that discount today, but the live market is holding in much better than what the futures appear. So the futures market maybe has sold itself out for now, but the fear we have is that we don't have a positive cattle market going forward. What we have is, we have increasing numbers moving forward, and we think it's going to be difficult until we get into the grill season in April, May. Then we think maybe we can see some surge at that point. But the big money in the cattle business, the big prices, we think that's past.
So probably range bound until we get some big news one way or the other on the demand side, do you figure?
We haven't determined the range yet. I mean, the range so far looks like from the upper left to the lower right. I mean, it's just been a straight downward move with some bounces, but another big bounce today. So maybe we're in the process of establishing a range, but so far we really don't have a few days worth of trade to even be able to point at that suggests we're ready to.
All right. Now, as we jump down and take a look at the feeder cattle market, that one has been fairly trading strongly within the week in the 190s. It's been all over the board in the 190s. Again, strong day on Friday. Does it look like that could be headed back northwards, do you think? Or
perhaps the problem is that if corn prices inch up a little bit, it's going to, and fat cattle prices don't recover, it's hard to justify feeder cattle moving up much. On the positive side, we saw with the cattle inventory report that we're holding back beef calves or heifers, and so we have fewer numbers of cattle to go into the feedlot as we're seeing that expansion occur. So supplies are going to continue to be very tight in feeder cattle, and pricing is going to be dependent upon where corn and fat cattle are.
No, I was down in San Antonio this week at the Cattlemen Convention talking to a number of producers, and they expressed some hope that when the wheat comes out of dormancy, those guys could be aggressive buyers for feeder cattle to run on wheat pasture. Does that historically have an impact in feeder cattle pricing?
Certainly does. Now, this year we have something that's a little unusual in that we reduced wheat acreage throughout most of that country that tends to put cattle on. The Kansas wheat acreage is down, the winter wheat acres, the Oklahoma wheat acres are down, Colorado wheat acres, Texas wheat acres are all down, and so there will be a few less acres available to or demanding cattle to be put on them.
All right, so it might have less of an impact this year
more important than anything will be the condition of the wheat. If the wheat is in the condition that it can be raised as a grain, then producers have to take a look at it a little differently. So all those are going to come together.
All right. Well, now let's take a look at the lean hog market. Again, up and down and up and down and across the board.
But mostly down.
Yes.
Mostly down except for today. We had a big rally back today. More hogs being taken to market than what people anticipated. If you go back and look at the pig crop report last summer and compare the numbers that we're getting today, we have more numbers coming to market, and that difference between the summer pig crop and the winter marketings is the biggest it's been since 1997. So for some reason or another, we have more hogs coming. The government undercounted. We're moving the hogs sooner. We're not sure exactly what the reason is. More and more people are settling in on there was an undercounting of the numbers, and if that's the case, then we have more problems as we go along here because the numbers are due to build.
So do you see this continue to trend downward through the year as these hogs come to market? I don't
see it continuing to trend downward for a long, long period of time. I just don't see reason yet for it to turn around and to start trending to the upside.
No big reason for a rally out there?
None that I can see.
All right. Well, John Roach, thank you for taking the time to join us this week.
Thank you very much, Mike.
That wraps up this edition of Market to Market. But John and I will continue our discussion and answer some of your questions in our Market Plus segment online. You'll also find audio podcasts and streaming video of our program exclusively at the Market to Market website. And be sure to join us next week when we'll examine efforts to preserve the history of the American farm. So until next time, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by Sukup Manufacturing Company. Offering a full line of grain drying and storage equipment and steel buildings, Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it.